Everyone loves SCHD for its dividends. But what if I told you there's more to the story? Something even die-hard investors often overlook. Welcome to the video. Today, we're diving into a topic that's been making waves in the investing world. SCHD, also known as the Schwab US Dividend Equity ETF. If you're someone who's been exploring dividend ETFs, chances are you've come across SCHD. It's popular, trusted, and often hyped up in investing circles. But here's the thing. There's a lot more to SCHD than what most people talk about. In this video, we'll uncover the surprising truths about SCHD that you won't hear from the typical investor or even some financial experts. We'll explore what's really going on behind the scenes, clear up common misconceptions, and help you better understand whether SCHD is as good as it seems. So if you're ready to learn some eye-opening facts about this ETF, stick around. You won't want to miss this. Chapter 1. What is SCHD? A quick overview. So, what exactly is SCHD? Let's break it down. SCHD stands for Schwab US Dividend Equity ETF, and it's one of the most popular choices for investors looking to build wealth through dividends. Essentially, it's an exchange-traded fund that tracks the Dow Jones US Dividend 100 Index. This index focuses on large, stable companies that consistently pay dividends. In simpler terms, SCHD is made up of companies known for rewarding their investors with regular payouts. The companies inside this ETF are big names. Think Pfizer, PepsiCo, and Home Depot. Solid, established businesses that aren't likely to go anywhere soon. What makes SCHD attractive is not just the dividend payment, but its performance over time. Since it started, SCHD has averaged around a 13 to 14% annual return. That's a pretty impressive track record for a dividend-focused fund. One of the best parts about SCHD is how it balances income and growth. You're not just getting dividends, you're also investing in companies that have the potential to grow over time. It's this mix that makes SCHD a favorite for long-term investors looking to secure both income and steady growth. Chapter 2. Misconception 1. Dividends are free money. One of the biggest misconceptions about dividend-paying investments like SCHD is the idea that dividends are free money. It sounds great, right? You invest and then get regular payments. But here's the thing. Dividends aren't just money falling from the sky. When a company pays a dividend, it's actually distributing a portion of its profits back to its shareholders. This means the company has less cash on hand, which affects its overall value. So while you might be receiving money in your account, the value of the company, and thus your investment, drops by the same amount. In other words, you're not suddenly richer. The money is just being moved from the company to your pocket. And it doesn't stop there. Dividends are subject to taxes, which is something investors often overlook. The company already pays taxes on its profits, and then you, as a shareholder, get taxed again when you receive that dividend. This double taxation can reduce the overall returns you might expect from those free payments. So while dividends can be a nice bonus, it's essential to understand they aren't free money. They come with a cost, and sometimes it's more beneficial for a company to reinvest its profits back into growing the business rather than paying out dividends. Knowing this can help you make smarter choices when deciding whether a dividend-focused ETF like SCHD is right for you. Chapter 3. Misconception 2. Stock splits boost value. Another common misconception about investments like SCHD is that stock splits somehow increase the value of your investment. Recently, SCHD went through a 3-for-1 stock split, and while many people saw this as a big opportunity, it's important to understand what really happens during a split. A stock split doesn't actually change the value of your investment. Think of it like slicing a pizza. If you cut one large pizza into 3 smaller slices, you still have the same amount of pizza, just divided differently. In the case of SCHD, your shares were split into three, but the total value of your holdings remains the same. The price per share goes down, but you own more shares to balance it out. So, why do companies do this? It's mainly to make the stock more affordable for smaller investors. When the price per share drops, more people can buy in, which can increase demand. But remember, this is purely cosmetic. The fundamentals of the company or ETF, including its dividends and overall value, don't change just because of a stock split. So, while stock split may seem exciting, they don't boost the actual value of your investment. Chapter 4. Why has SCHD underperformed the S&P 500? Now, let's talk about something that might surprise some of you. SCHD has underperformed the S&P 500 in recent years. A lot of people assume SCHD is a safe bet because of its strong dividend payouts. But when compared to the S&P 500, it hasn't delivered the same returns. Why is that? The answer lies in the type of companies that make up SCHD versus those in the S&P 500. The S&P 500 is heavily influenced by large tech companies like Apple, Microsoft, and Amazon. These companies have been driving much of the market's growth over the past years. But here's the thing, they don't pay significant dividends. Instead, they reinvest their profits into further growth, which has pushed their stock prices higher. On the other hand, SCHD focuses on more stable dividend-paying companies, which are often in sectors like consumer goods, healthcare, and energy. These companies provide reliable income through dividends, but they don't experience the explosive growth that tech stocks have seen. That's why SCHD has lagged behind the S&P 500, especially during bull markets driven by tech. But don't write SCHD off just yet. While it may not soar during market booms, it offers something that the S&P 500 doesn't: protection during downturns. SCHD's lower volatility means that when the market dips, SCHD tends to fall less dramatically. This makes it a more stable option for long-term investors who prefer consistent income over chasing growth. So, while SCHD hasn't outpaced the S&P 500 recently, it still plays an important role in a diversified portfolio, especially for those focused on steady income rather than high growth. Chapter 5. The role of beta and R-squared in SCHD's decline. Let's dig deeper into two important metrics that can explain SCHD's recent performance: beta and R-squared. These might sound complicated, but don't worry. I'll break them down simply. First, beta measures how much a stock or ETF moves compared to the overall market. A beta of 1 means it moves exactly in line with the market. If it's higher than 1, it's more volatile, and if it's lower, it's more stable. SCHD usually has a beta below 1, meaning it's less volatile than the broader market. This is great for conservative investors because during market downturns, SCHD won't fall as hard. But in bull markets, like we've seen recently, SCHD doesn't rise as fast as higher beta stocks, which helps explain why it's underperformed compared to the S&P 500. Now, let's talk about R-squared. This metric measures how closely an ETF follows the movement of the broader market. SCHD has historically had a higher R-squared, meaning it followed the S&P 500 pretty closely. But in 2023, SCHD's R-squared dropped significantly, even turning negative at one point. This means that while the market was going up, SCHD was going down, a rare occurrence. The reason for this is the underperformance of the companies that make up SCHD's portfolio. While this might seem like it's bad news, it actually creates a potential buying opportunity for long-term investors, especially those looking for stability in a market downturn. Chapter 6. The hidden value of SCHD in a market downturn. Now, let's talk about one of the biggest advantages of SCHD: its performance during market downturns. While SCHD may not outperform during booming bull markets, Its lower volatility and consistent dividends make it a solid choice when things get tough. Thanks to its low beta, SCHD tends to drop less than the broader market during corrections or crashes. This means that while high-growth stocks might take a nosedive, SCHD holds up better, protecting your portfolio from major losses. And let's not forget about those dividends. Even when the market is down, SCHD's holdings are made up of companies with a long history of paying dividends. So you're still getting income even if the market is struggling. For long-term investors who value stability and reliable income, SCHD is a great option to weather market storms. You won't see explosive growth during the good times, but you also won't experience the same extreme declines when the market turns sour. This makes SCHD an attractive choice for those looking to balance their portfolio with a steady, income-focused ETF. So, in a downturn, SCHD can offer a kind of safety net, providing both lower risk and steady income. That's it for today's video. I hope you found these insights about SCHD helpful and learned something new. If you did, don't forget to hit the like button and subscribe for more content on investing and finance. And if you have any thoughts or questions about SCHD or dividend investing, drop them in the comments. I'd love to hear from you. Thanks for watching, and I'll see you in the next video.